How much cash flow should you make on a rental property? That is the question we are answering for you today. If you are new here, welcome. My name is Tony Stephan. Together with my wife, Andrea Stephan, we own 258 rental properties. We talk about cash flow all day, every day. So we're going to break this down for you. We also own a real estate brokerage as well as an online coaching and consulting company. And we share our journey onwards towards 1,000 units to help you in your journey. Today, we're talking about cash flow. As a real estate broker, this is probably the number one question you get asked from people. Like when people say, I want to invest in real estate, they're thinking cash flow. High level, maybe we've got a brand new person listening to this. We want to really break it down and create just like almost like a free library here of resources for people when it comes to real estate investing. All right, so let's just give everyone watching a simple cash flow explanation. Okay, so I have a duplex. It makes $1,500 a month. Punch in on that there calculator. Right. $1,500. Yeah, show the people. $1,500. All right, now my mortgage, right? $900. So subtract $900. Then let's say property taxes, $150. Maintenance and repairs, $100. Property management, $100. And then vacancy reserves for $50. Okay, so how much monthly cash flow is that example?
$200.
Okay, so if I'm your client and I'm assessing a rental property, would you say $200 is good monthly cash flow on a duplex?
Yeah.
I agree. I feel like if you can get $100 pure cash flow, and this is like pure cash flow, this is after everything is paid, that's a pretty good deal in today's market.
Right.
What are you advising from people, or what are expectations you're seeing? Because I've heard people say, I want to buy a couple deals and get $30,000 a month in cash flow. Do you know how hard it is to get $30,000 a month in cash flow? Like we have 258 units. Do we get $30,000 a month in cash flow? Maybe, it's so variable, which we'll get into. But what would you say is a good monthly cash flow? What's the expectation?
Well, it all really comes down to how much you're putting down. So that's where it's like the expectation should be guided by your down payment.
I've never heard anyone say that. What can you elaborate? What does that mean?
So for example, I have a client that they've been buying investment properties for like 2-3 years at this point. The properties they bought last year, they were doing the minimum 20 to 25% down by the lenders that they were using, right? Their cash flow was, and they were single family homes, $200, $300, $400 a month, good areas, right? So appreciating areas. But their strategy this year was, I want the cash flow, so I'm going to put more down. This year, they're putting 50% down on their properties.
Wow. So there's how much cash flow? I'm just like an approximate example.
Yeah, I mean, an approximate example. Let's just say like $1,000 a month.
On a duplex?
This is a single family home.
Single family home.
Yeah.
Not bad.
Right.
More leverage, right? So I love that. Let's talk about some of the factors. I think it really comes down to what are your goals and what's a good cash flow to you. That's like saying what's a good return on investment or what's a good bench press? Well, I mean, depends, right? What are the factors that influence cash flow? I think we want to start off and say there's a big difference between spreadsheet income and actual income. And that's when we started investing in real estate, because again, our goal is always to share our journey to help you guys. I would run these spreadsheets and I would run these analysis, right? I would show them to you, remember? And it would look good on paper. You're like, look, this is how it's all going to go, right? Well, does real estate follow a spreadsheet or no?
Not really.
No, not at all, right? You're buying a business and you're buying a business as a physical product that has moving parts and real life human beings, right? Things don't go according to plans at times. So understand there's a big difference between what you feel like you're going to analyze the income to be and the cash flow to be versus what can actually happen. What are some unexpected things that have come up in year one of ownership of owning rental properties? And maybe think back not towards like our 100-unit apartment today, but like back to our smaller stuff that would maybe really eat up or eliminate cash flow in that first year.
I think just like taking over new management, whether if it's a house that somebody's living in and you're managing as a tenant, or a duplex, sometimes people get a little bit spooked with a new owner. Yeah. So they might move out for something of saying like maybe they were friends with the previous owner and they just move out and that wasn't expected. So maybe a move out might happen that you weren't accounting for.
Which then adds up to what?
There's vacancy and the unit turn.
And leasing.
Correct. If you're not leasing, yes.
All of which eats up cash flow.
Correct.
I would say vacancy is probably the number one destroyer of cash flow.
Absolutely, yeah.
Because you'll never recoup that.
Right.
If there's damage, you might be able to recoup it in like billing them back. If there is fees or whatever, right, or utilities. But like vacancy, because there's no one to bill that to. That's like you did not fill that unit. It's just loss of income.
Correct.
A big thing we've learned is try to eliminate vacancy as much. Like in the beginning, I was always like push for the highest dollar amount, push for the highest rent, market. But sometimes the best thing is keep the heads in the freaking beds.
Right.
Because when you look at how much it costs to turn a unit, market a unit, lease a unit, and then just loss of income of you in 1 month. If you're renting at $1,500 a month and it's vacant for 1 month, that's $1,500.
Right.
To get a $25 rental increase.
Right. Not worth it.
Right. So that's a huge thing. How much does location play into cash flow?
It's huge. Yeah, I mean, it's huge. So, I mean, we're in Metro Detroit, right?
Yep.
So I see the people that chase the high cash flow in these low areas like Detroit, Pontiac, Flint. You can buy a house for like $60,000. I've never done it, so I don't want to misspeak, but just other agents or other investors I talk with, you know, you could put a Section 8 tenant in there, 12, 13, 1400 bucks a month. And so that's really good cash flow, right?
Yeah.
But I have a lot of people that then come to me and say, just get rid of this house because I cash flowed. They moved out. They stole everything.
You've had that multiple times.
Oh, yeah.
They're like, just
get rid of it, right? Or the city was difficult to deal with. Like I definitely know that Detroit, it is very difficult to deal with, like the permitting, getting it certified for rentals, right? So that can delay collecting your income as well.
So location is a huge thing that people need to consider when figuring out how much cash flow I'm going to get. Financing and debt.
Correct.
Like when we started, debt was 3 and 4%. I remember on our first multifamily deal, we got a 3.9%. I was mad. I was like, dude, they're getting 3.5. They're getting 3.25 over here.
Yeah.
Like you guys are screwing me. Everything cash flowed at 4%.
Yeah.
I'll tell students sometimes when they're analyzing a deal, they're like, so tight at 7%. I'm like, just for fun, put the debt to 4%. Oh my God, this is so much better. And that's been the challenge in the market nowadays is prices are staying elevated because there's limited supply. I just saw a report. It said there is the lowest deliverance of new multifamily supply in Metro Detroit in the last 10 years. It means we have the least amount of new apartment buildings coming available in 2026 in the last decade.
Yeah.
Because they haven't built, because it's so expensive to build. So sellers want their price. Investors are coming in wanting to put 25, 30% down, but debt is so high, it doesn't make sense to do that because it's a barely break even thing. So debt is a huge part of it. Now, we don't want to create the excuse for you guys to say, well, debt's 7%. We can't do that. I mean, our highest interest rate is 7.75%. And then we have things all the way down to like 5%, you know? So if this is the new norm, you just have to embrace it. You have to look for value added creative opportunities to where there's so much upside in the deal. You're just losing money by not doing it. Right. So that's a big part of it. Management and operations is another big thing to increasing cash flow. Can you talk about how have we been able to strategically increase management and operations to increase cash flow?
Yeah, so it's mainly about very high level lowering your expenses. So again, like you don't have to make it this complicated thing. You can even just start like with one thing on your expenses. So in Michigan, right, we have snow. So every year we should be reevaluating the snow contracts, and when spring comes around, reevaluating the lawn care contracts. That's one really easy thing to just look at right from the get-go of your contracts. Can I do it? We're thinking back to like our first duplex or single family home. Is it something I want to do, or is it something that I can use a contractor for a lower amount?
What other like management things? I think a big thing you do is, or when we had third-party management. So when we started, if you're new to our story, we had third-party management up to 87 units. Then my wife fired them and took over the management on that fateful discussion of you're like, they're robbing us blind, essentially. There would be like a leak and they would just send a plumber. And like a plumber is very expensive, right? As to where like then you took over, you're like, well, not everything requires that.
Correct.
So maybe if I'm a new investor, how do I decipher, like, do I just pick up the phone? Because that's what ate so much of the cash flow up, was it was just like very reactive. And it's like, okay, oh, the lights are flickering, send an electrician.
Right.
It's where you have this like Rolodex of like handymen that you send out for 25, 30, 40, 50 bucks an hour. Versus electricians, 150 just for the visit.
Especially if it's emergency.
Yes.
So if it's, and typically plumbing is something that you want to look at right away because it could be something very silly or it could be a huge issue that could cause a major issue. So there's a couple things we always troubleshoot with the tenants too, because sometimes it is just something very simple that they can just do themselves. We're on the phone with them, guiding them through it. Either another manager or our handyman is doing it. So that's a huge way to save. And then again, yes, sending a handyman before the actual plumber or the electrician, because again, I'd say 9 out of 10 times you don't need someone to go out there to just evaluate like that.
Any other big things third-party management kill us on cash flow with?
That and unit turns.
Yeah.
Unit turns. I mean, yeah, it was just, I mean, it can get expensive to run properties, right? If you're not doing it the right way. It's exactly what you just said. You're using all these third-party companies. If you just call a plumber, I mean, they're easy $200 just to go out there. And some of them won't even apply their trip fee
to like the
service. So yeah, that's such a key thing to make sure you have the right maintenance technician.
You know what trips me out was like everyone's like slumlords, land leeches. It's so wrong that we take money from people to live. What about the plumber that takes money from you to fix the toilet?
Right.
Is a toilet not a necessity in life? It's funny though when it just comes to housing, you know, it's an interesting thing. So let's talk about the 1% rule. I think if you're looking for a baseline, what is a good way to determine cash flow? Use the 1% rule. So if you're going to spend $200,000 for a property, on paper, if that property rents for 1% of that purchase price, which is $2,000 a month, there should be cash flow. Just as a basic, quick, like I love quick, dirty analysis, that is extremely possible. When we bought a single family rental in Las Vegas, Nevada, that home was what, 500 grand? And the rent was 2,500 bucks.
Right.
Now that home then sold 7 months later. No, I think we paid 590. Then we sold it 6 months later for 660.
Yeah.
No, it was 75,000. That's what we made.
Yeah.
So whatever that math was. So here's a market where there's rapid appreciation, but there's very little cash flow.
Right.
That was not a cash flow market. I think
Right.
our rent was about break even.
I remember talking to a property manager and he owned a couple properties too.
Right.
And he's like, a lot of people out here in these areas you're looking at, they will pay for the first couple years a little bit out of pocket to keep these properties because they know if they hang on to it for 3, 4, 5 years that the appreciation is so crazy.
It's just
So it's a different market.
Different market and different strategy.
Yeah.
Are you willing? I remember Bedros, our mentor, told me that in the beginning he would pay a little bit every month.
Right.
That's what I mean. People in Metro Detroit get so freaking spoiled. We've never bought a property where we are feeding it every month. People get so spoiled. They're like, I'm only getting $200 a month in cash flow. Like there are markets out there that you get a lot of appreciation,
Right.
but you have to pay that every month. Then if something goes wrong, you're paying on top of that. That's a nerve-wracking game, especially if you're on a tight budget.
Right.
If you have so much discretionary income, then you're like, okay, whatever. But I think if you're getting $100 to $200 a month in pure cash flow, that's great. And the 1% rule is very achievable in Michigan.
It is. Yeah. No, I just had a client close on a property. It actually exceeded the 1% rule. So
Give us the
details of that. Yeah. So that deal, he bought it for $150. So it exceeds the 1% rule because then he's getting $1,750 in rent. And that was a really good deal. Tenant was already in there.
Out of state buyer?
Out of state buyer. Just a good, easy property to start with.
Look for these easy wins. Is it getting harder and harder to find? Because you're a real estate agent and broker. You deal with a lot of newer investors. You know, when we start to look at larger multifamily, there's really not like a 1% rule. When you're looking at these smaller deals or new first-time investors, are you noticing is cash flow really gone in 2025? Was that like an anomaly? Or are you able to find these clients cash flow producing deals even with these higher interest rates?
You know, it's definitely getting harder, but the thing is that when I talk with clients, it's more about the potential of the property. So it might not cash flow on day one. And I also see a lot of these like 1 to 4 units that are already rental properties, or if it's a single family home, a 1 unit and it's vacant, obviously you're controlling who you're putting in there. So again, on day one, yes, it's not going to cash flow because there's no tenant in there.
Right.
But who are you going to put in there? And you should be able to get the rent to make it cash flow. 100%. And then with it already being tenant occupied, well, if you're looking at properties which if it's not cash flowing because the rents aren't high enough, then you need to take the 3 to 4 months to break even, and then it will cash flow after that. So that's where I see people get tripped up. On day one, when I take over, I'm not cash flowing. But you got to put in a little bit of work to make it cash flow.
I'd say majority of deals we buy does not have significant cash flow on day one, especially now that we're talking multifamily. It's the value add play, right? So we see a lot of people who come in and they're like, I want to buy for cash flow and I want to buy X amount of rental properties, quit my job, replace my job. Again, back to on a spreadsheet, looks really good, sounds really good, but back to theory versus application. Is cash flow predictable enough? Now that you've managed 258 rental properties, is cash flow a predictable metric enough to where you, let's just say you personally, would ever feel comfortable quitting your job to live off X amount of cash flow? Like if I'm making $10,000 a month, is it predictable enough, or is it so volatile and variable at times that you're like, man, some months I might be eating beans and rice here?
Yeah. Yeah. I mean, I think you'd have to have a really good budget after, I'd say maybe 5 years if you kept the same properties.
Yeah.
Right? You kept the same properties. You know that the roof's going to go in 10 years. You know that it's going to need a new AC unit in 5 years. Then you can plan for that. But if you're constantly buying and trading up, I wouldn't advise that until you're more stable, because I think the cash flow becomes more predictable. We've said that, like our 7 unit, we did the big CapEx projects. Our tenants for the most part are staying and renewing, so we kind of see the patterns with that. But that we've had that for what, 4 years maybe?
2021, so yeah, 4 years.
About
now.
4 years. So that one I'm like, okay, I'm very comfortable. I really know that property. It's a little bit more predictable. But for that new person, like year 1 or 2, no, I would not feel comfortable doing that myself.
No, I love what you said. It's just year one so variable. You have no idea. You coined the phrase, it's not your property until a year later, where you've had that property for a full year. So that's why we look beyond cash flow. You know, cash flow is a metric. And it's a sexy metric because it sounds really sexy to own a property, receive passive or semi-passive income, right? Because you're not directly working for that money, get mailbox money and all that good stuff. But we really pride ourselves on telling the reality of owning real estate. Cash flow is an up and down metric. And whatever the spreadsheet says, I guarantee is not going to be the case.
Right.
Could be higher, could be lower. And I love what you said, that after you've owned a property 3-4 years and it's been just kind of stabilized, that's where you really get to understand what is my cash flow. But at any time, a major expense can come in and wipe out your cash flow for a year on a smaller property.
Right.
So that's why we look at appreciation, right? Like you said, there are some markets that go up really, really rapidly. We love the BRRRR strategy to where we can buy a deal, increase its value, and then refinance, right? Get a large chunk of equity out, get original down payment out. And that's why I've always said that I don't care how much cash flow is there. If it makes 10 grand a year, I don't care because I already have all my money out. To me, that's a better strategy. Get all of your money out of the deal with the BRRRR strategy, refinance, because then cash flow is like, you have a free property at that point. Like if I just gave you free 4 units, you put no money into it. Do you really care? Like this month it was 100, this month it was 500. It's free.
Right.
Your return on investment is infinite because you have no money in the deal.
Yeah.
So there's that. Depreciation, tax benefits, which I've talked about ad nauseum on this channel. We've done so many videos on it. Like nothing beats buying a rental property and getting a massive tax write-off because you're a what?
Real estate professional.
I had someone ask me on this. That's just 750 hours.
750 tracked hours. You know, if you ever did get audited, they're going to look for that documentation. So get in a habit of that. If you're tracking your hours, just like you're tracking your income, you should just get in the habit of tracking all that kind of stuff. So
real estate also has leverage. So you can buy $1 million property, put $300,000 down and control $1 million property, get all the tax benefits, get the cash flow, get the appreciation on it. You can't take $300,000 and go buy $1 million worth of stock.
Right.
It doesn't work that way. You can't leverage that, right? So if you buy $300,000 worth of stock, that's a 1-to-1 value there, right? So again, people overlook. I think people just get so spoiled.
Yeah, I think they just want like the extra, or like, oh, I can use this for like vacations and stuff, which is cool. Like you can, it's an investment. You are getting that in your pocket every month and you are making that additional income. But again, like you said, the first year is a little unpredictable and you just want to make sure you're stabilized, because then if something does happen, I mean, we've kind of gone through a lot of different things of like, unfortunately, like tenants have passed away, and then we've had things where like items are left in units, very unexpected things that like you're not going to read in a book. And I've come across things like every year that I'm like, who knew that could happen? I think that the biggest thing is, again, we've kind of talked about, it's like these are their homes, right? So there's like people move away for jobs, right? Relocation, right? You have this lease that you're like, okay, well, I'm not gonna, they have to pay the lease until it's over no matter what, right? Well, I got relocated because I'm in the military and I have to leave, and so does, like, I mean, you're not gonna collect that, and you're gonna also say like you're gonna let somebody out of their lease for that, right? So that there's just kind of like some unpredictability that wouldn't expect.
Plan for cash flow, analyze for cash flow. You definitely want cash flow, but understand it is a piece of the puzzle when it comes to real estate investing. Focus on appreciation, focus on the tax benefits, focus on a long-term investment. Don't look at it as a very quick, like, where am I at today when I first buy this deal on day one? Look at where can I be in year 1, year 5, year 10. That's when things really, really get exciting. It's exciting owning rental properties for 4 or 5 years now, really being like, wow, this is now, look at where it is today compared to where it's been. So what are your thoughts when it comes to cash flow? Are you a cash flow investor or more of a BRRRR investor like we are? Let us know. Put it in the comment section below. If you made it this far in the video, thank you so much. Drop a meaningful comment in the comment section. If you want to learn more about real estate investing, we have tons of free resources to you. Always make sure you comment and subscribe to the channel, but grab our free real estate investing masterclass, grab my due diligence checklist. I also grab my book that sells for $19 on Amazon, absolutely free. If you're looking to learn more about investing in the state of Michigan and getting this 1% rule, getting this cash flow producing real estate, click the link in the description to fill out a form to book a call with one of our team members. If you're looking for more one-on-one coaching and mentorship, fill out the link in the description to learn more about the mentorship program. And as always, thank you so much for being here. We look forward to helping you get to your goals with real estate investing. Until next time, we'll talk soon. Thanks.